Today we are talking about the rules of the game. And as it pertains to our financial life, if you think about our financial life in general, there's really the big three, and then there's us. And the big three are the government, financial institutions, and corporations. There are two different sets of rules, and there's the rules that they teach us to play by, and then there are the rules that they play.
Think about retirement. We ask this question all the time. If you could show up to retirement with, let's say, $2 million in assets and also have a $2 million death benefit, or show up in retirement with just $2 million in assets with no death benefit, which would you prefer?
2 million and 2 million.
Welcome to the Cashflow Legendz podcast with your hosts Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back to Cashflow Legendz. Obviously, we've got one voice down today. Brandon is out doing what he loves to do, which is play baseball. So he's out in Arizona for the next few weeks playing baseball. I don't know if we'll get him back next week or not. We'll have to see. See how his schedule lines up with ours. But you got me and Brock here today. And Brock, how has your life been the last week?
It's been good. I played last week was easy. The week before that I got to play Pebble Beach and just back to work and doing all the things, and had, all the wedding planning festivities happening in my world right now. So that's a lot of fun.
Oh yeah.
In today's my dad's birthday. So
yeah.
Shout out to my dad.
Shout out to Trent Fortner. So I can think it's been quite a few years, but I can think back to those days of planning our wedding, and I don't envy I don't envy where you're at right now.
That's funny.
I was very fortunate in the fact that my wife was very frugal, and was not dead set on going crazy on things. So we were very practical in a lot of the things that we did. And if I told you how much our wedding cost in total, most people wouldn't believe me, because we had a lot of people who just stepped up and helped out, because we were two broke college kids at the time. Her family, she comes from a ministry family. My family, small business owners, like neither one of us were rolling in money or anything like that. So very grateful for the help that we received early on in life. And the people who just kind of poured into us and loved on us during that time.
Yeah.
But
that's awesome. What about, how about your week? How's your week been running up?
It's been good. My wife's granddad passed away recently, and so we had the funeral last week, and I was asked to preach his funeral. And it's the second funeral I've done for someone that I was deeply connected to, someone that I just felt very strongly about. Obviously I loved him, and so I made it through, but it was tough. It was one of the tougher ones that I've done, for sure.
Yeah.
But family's doing good. Everybody's kind of getting back into rhythm of different things. Kids are just all into sports right now. Volleyball just ended, so now basketball season's starting, and so it never stops. Although this is the first time in a very long time that basketball season has started, and I don't have boys playing basketball.
There you go.
Yeah.
Nice.
So it's a little bit different.
Yeah. Well, speaking of sports, today we are talking about the rules of the game, and as it pertains to our financial life. And there's really 4 rules. If you think about our financial life in general, there's really the big 3, and then there's us. And the big 3 are the government, financial institutions, and corporations. And if we were to look at, you know, personal finance versus uh, corporate finance. I was about to say commercial, but corporate finance. There are two different sets of rules, and there's the rules that they teach us to play by, and then there are the rules that they play by. And it was funny as we were talking about this episode and getting ready to talk about it. One of the things that I thought back to and often think back to when we talk about this is when I was back in school and, at Vanderbilt, I have a degree in finance, master's degree in finance, and it was a lot of corporate finance. And in undergrad, it was all about corporate finance. But the fun part was I actually also took personal finance classes. And in the personal finance classes, we always talked about compound interest and how a bond works and how it pays out and how if you stay in it long enough, you'll compound and it'll be great. But then when you talked about corporate finance, not once did we ever talk about compound interest. All we talked about was, revenue, expenses, profit. How do you grow? Number one rule of business is increase shareholder value. Like those were the things that we talked about rather than compound interest. And so if you look at our world today, those rules that the big three teach us to play by are they want our money on a consistent, systematic basis. They want to get it for as long as possible and hang on to it for as long as possible. And then when it's time to give it back to us, they want to give it back to us in the smallest increments as possible. And, you see these rules and sometimes you question them, but then we start adding, background to it and it starts making sense to you as you start seeing them. So when you first heard of those rules, Nate, what was it that you thought of?
Well, I think it's interesting that in the world of business, you're taught to reinvest back into your business. But in the world of personal finance, rarely are you taught to reinvest back into yourself. And there's an underlying reason for that, and it's because the system is really designed not to empower us, but to enslave us at some level.
Mm-hmm.
But when I think about those rules, the funny thing is we follow those rules really unconsciously, like because very few people actually take a step back and ask, why are we doing this?
Mm-hmm.
These unwritten rules essentially that are out there, like, why are we all doing the same thing? And I quote this so often, so it's, if any of you listen long enough, you'll hear it many times. As a wise man once said, if you want to be successful in life, observe the masses and do the opposite. And we have been indoctrinated at a young age to essentially feel good about what we're doing as long as other people are doing the same thing.
That's right. That's almost always right. I'm going to pause. We're going to pause the recording for just a second because there's
good.
a wasp. There's a wasp right here. Yeah, and I think when you were talking there, Nate, one of the things that I was thinking about was kind of like our medical world today. Like for the longest time, nobody questioned anything about our medical world until COVID came out. And then everybody started kind of questioning, why are we doing some of these things? What are these things that are going on? And I always love working with chiropractors because they're so against the grain of normal medical world type thinking. And they resonate so much with the way that we think about our finances. And I think it's so common that people will just do what they do because that's just the way it's always been done. And I think about that meme that comes out every year about Thanksgiving time when it's like, Mom, why do we cut off this part of the chicken and put it in the pan? She's like, I don't know. That's just the way I was raised. Go ask your grandmother. And then you go ask the grandma. She goes and asks the grandmother, and she goes, oh, well, that's just because we didn't have a big enough pan when we first started doing this. And it's like, okay, well, sometimes we got to go ask why we do some of these things that we're doing. And I think that's the thing that a lot of people just don't do, is ask the questions of, why are we doing this? What's the point of doing some of these things?
Yeah. So let's talk about the first rule. Institutions need our money. And this may be just so common to most people, but to other people, they have no idea how banks actually make money. Banks and institutions make money using our money. If we don't give them money, they don't produce a profit.
That's right.
And there's a large percentage of people that do not understand that.
Yeah. It's kind of interesting to think about it, because if you looked at a bank and you asked what type of products do they sell, like what products did they create, services did they create that they get to sell to the masses? Well, if you break it down, they don't really have anything if it's not for us, the people putting the money in the bank. And so when you think about it, if you were the president of the bank, what would you do? Like, how would you create a way for people to put money into your coffers, into your bank? Like, how would you get people to do that? Well, you do it in a way that they think benefits them. And then you talk about the fact that you want to do this, automatically and systematically. Hey, direct deposit. Money goes straight into the bank. All right, well, now we can move money. It's called an ACH. No fees, no gimmicks, no. I think of that Capital One commercial when they're like, Derek Jeter, and the credit card guy. And they're like, how'd you do this? And he's like, oh, no, not you, Derek, the credit card guy. And, but you think about that first rule along with banks, but then you think about, what about the wirehouses? How do they get people to give them money? Who are the biggest corporations? These wirehouses. Well, they can, if they have all of this money, right? They control a lot of our economy, and the government is incentivized to partner with them. Well, what is one thing in our world that most Americans do on an automatic, systematic basis? 401ks. And who benefits the most off of 401ks? Us or the big three? Well, if you took a look at it, definitely the big three, because number one, it's automatically and systematically deposited into the wirehouse. How? Well, right off of your paycheck. You don't even have to think about it. It just happens. It's easy to get into. Well, money now is at the wirehouse. It stays there. It's invested there. How does the government benefit? Well, when you take the money out of the account, is it usually bigger than what you put in? Yeah. So then when you take it out, if it's ordinary income tax, government gets the benefit. And what's this? I don't know if you know this, Nate, but like this fun new rule that the government created a couple years ago around what happens if you die with a IRA or a 401k. Do you know what happens? Or do you know what the inheritor has to do with that?
Well, they have to pay taxes on it.
And when do they have to pay taxes on it?
Immediately.
Almost.
Yeah, almost immediately. Yeah.
They have 10 years that they have to spend that down.
Right.
Right? They have to pull all of the money out of the account within 10 years, or they'll get penalized on it.
Yeah.
They know exactly what's going on, especially even with, these accounts during retirement. Well, you might say, oh, well, I'll just defer the taxes for forever, and then I won't have to worry about paying taxes on the money. Well, guess what you have to do starting at age, I think, 72 or 73, depending on when you take it or how old you are. You have to take RMDs. Why do you have to take RMDs? Well, because the government has to get paid their taxes. So they're going to make you take it. And if you don't, they're just going to make you pay more taxes. And the tax used to be 50%. Now it's 25%. They're so gracious with that.
Yeah, I'm so glad, as Nelson Nash used to talk about, so glad that the government creates problems and then creates solutions for the problems that they created. And Nelson said, anytime that occurs, shouldn't you be a little bit suspicious of that? Of whatever those little loopholes are or whatever is created. The funny thing is most people don't don't understand this, that the original mastermind behind the 401k, his name's Ted Banna. And Ted Banna said the 401k became something that it was never designed to become.
Yeah.
It because originally it was essentially for deferred compensation. It was for like employee bonuses and things like that. It was not intended for a percentage of every one of your paychecks to go into. That was not how it was originally designed, but that's what it became. Because they figured out how to incentivize people to get them off the pension plans. And once companies figured out that they could wash their hands of the liability of being a cash flow engine for someone for the rest of their retirement years, and basically force them to take on the responsibility of creating their own cash flow system, it was a no-brainer. But and all it cost the employee, all it cost the employer was the employee match. That's all it cost them to rid themselves of that liability. And what I tell people all the time is Wall Street is the world's largest casino. Why do they offer comps at the casino? It's an incentive. It's not because they're losing money. It's to force a certain type of behavior.
Yeah.
Well, that's what the employee match was the comp.
Yep. And I think a lot of people downplay the transition in our economy when we went from defined benefit plans to defined contribution plans. And I think one of my favorite books that talks about this is How Privatized Banking Works. Great book. I love it. And
Got it right here.
that really, there you go. That really changed our economy in a massive, massive way, because it took the risk and the weight off of the corporations and put it all on the employees. Well, now it's no longer the corporation's fault if you can't retire. Just keep working or just keep putting money into it. So the first two rules, they want our money and they want it on an automatic, systematic basis. The next reason is they want to hold on to it for as long as possible. Or the next rule is they want to hold on to it for as long as possible, right? Now, Nate, why would a corporation or a bank or a wirehouse government, why would they want to hold on to our money as long as possible?
They want to create as much value for themselves as possible during that time period.
Yeah. So when we leave money in the bank, what do?
Oh, they loan it out. They put it to work.
And if you take it out?
If you take it out?
Yeah, if you take the money out of the bank, what are they not going to do?
They're not earning any interest on it at that point. And when it comes to like qualified plans and things like that, one of the things that is really fascinating is that there's some who have studied this and believe that the employee match that we were talking about earlier is basically just going to cover the tax on the account one day. So what you're effectively doing is locking up money for 85% of your adult life for the employee match to just cover on the taxes. And if you've listened to us long enough, you know that we're not just completely against qualified plans and things like that. What we are against is people putting money into things that they don't understand. And that's what most people are blindly doing. If you understand exactly what you're doing when you're contributing to those accounts, I have no problem with what you're doing. But if you are just following the masses because that's what you were told to do and you never ask why, that is a problem that needs to be resolved.
Yeah. And you think about it, like qualified plans are one of the four most powerful drawers on somebody's financial model, right? They provide 4 to 5 benefits to someone, and you should take advantage of them if you can. We're not saying don't, but understand the rules of the game and how to play by them or play with them to your advantage. And so when you think about this, they want our money, they want it on an automatic, systematic basis, and they want to hold on to it for as long as possible. Well, how are the ways that they get us to keep it in there as long as possible? The simple things are they put fees on it. They tell you that
Penalties.
they put,
Yeah.
taxes on it. And they teach financial advisors or people promoting these things about, hey, you need to be in it for the long haul. Hey, this is how Miracle of Compound Interest works. Hey, you just need a dollar cost average. This is a long-term plan. Hey, just ride out this tough part. And that's all it is, hey, just stay in it as long as you can. And then when it's time to get the money back, they want to give it back to you in as little increments as possible. And this is that fourth rule, which is, again, they want to give it back to you in as little increments as possible. And how do we see that? Well, interest only, the safe withdrawal method. And so if you put all of this together and you thought about it in a typical financial planning setting, remember, 4 rules. They want our money on a consistent, systematic basis, hold on to it for as long as possible, give it back to us in the smallest increments as possible. Max out your 401k, automatically, systematically, consistently putting money in their position. Hold on to it for as long as possible. Dollar cost average, miracle of compound interest. Put money in 529 plans, 401ks, brokerage account. Just leave it there. Don't touch it. You can't touch it till 59 and a half. Then you get to smallest increments as possible. Well, Brock, how do they do that? Well, why don't you just buy term and save the difference? Cancel your term insurance, and all you have left is your investments. Well, what do they teach us when that happens? Well, that's called the safe withdrawal method. You can only take 4% of your money so that you don't run out at some point. Well, that's just all they're teaching you to do is, hey, let's give you the rules on how to play so that as life continues, as you go through life, you'll think you'll be doing all the right things and following our rules the way that we want you to play by them. And you're just following the herd. That's the mentality of these rules because it way more benefits the big 3 than it does us all along the way.
Yeah, and the conundrum that people face in retirement often when we're talking about this withdrawal rate and everything like that, they say this is the safe withdrawal rate, but they're also not assuming massive losses in the market along the way. And so the conundrum that most people run into, I've used this example before, and normally I would do it with a water bottle, but I've got my mug right here. All right, so you get stranded on a deserted island and you find this mug right here that's full of water. How do you know how much water you can drink out of this cup in order to survive? You don't have enough information. And the reality is that's one of the reasons why people immediately get pushed into scarcity mode when they go into retirement, when they've been following the accumulation model for so long. Now they've trying to figure out, okay, how much can I sip off of this off this mug in order to make sure that there's enough for me when it's all said and done. Longevity is one of the biggest dangers in retirement, outliving your money. And when you think about retirement, we ask this question all the time. If you could show up to retirement with, let's say, $2 million in assets and also have a $2 million death benefit, or show up in retirement with just $2 million in assets with no death benefit, which would you prefer?
2 million and 2 million.
Absolutely. And the reason why that's so powerful is because when you have a death benefit that's equal or greater than your estate, it gives you permission to enjoy your assets in a different way. Because you might have 2 million in assets, but if you're a parent or a grandparent at retirement, you might also, as most people do, say, I would love to leave something to my kids or grandkids one day. Well, you don't even know what you're capable of leaving them because you're stuck trying to figure out how I got to make this last for myself. And then, hopefully leave something. But like there's so many variables that have to be factored into all of that. And one of the things that's so beautiful about whole life insurance is it makes decisions easier.
Mm-hmm. Yeah. One of the things that a lot of people don't talk about is the actuarial science of life. Like, there's a reason why life insurance companies are so profitable. They know when people are going to die. Well, you can use that type of science within your financial planning to help you have a better uh, outcome when it comes to your retirement income. And so you got to think about, all right, well, here's the rules that they tell us to play by. What are the rules that they play by themselves? Well, velocity of money, create more value, create more income. How do you keep more money? Because money in motion tends to stay in motion, while money at rest tends to stay at rest, right? You want to be thinking about these things of, planning for the future. You want to plan for contingencies. You want to plan for, hey, if something doesn't go right, how do we adjust and continue moving forward? And they don't just plan for, one of the things that I love about the big three that they don't teach families to do is they just plan for like generations. There's not a, hey, we're just going to plan until retirement and then we're going to be done. No, what business is in the big three, corporations, government, is they just plan. They do 1 year plans that add up to a bunch of, one long plan, but they're making the best decisions at a time because they're planning generationally. And they have a thought process that says, hey, I'm making a decision today that's also impacting 30, 40, 50, 60 years from today, right? They're not just, hey, one day, someday we're going to shut this thing down and then we're done, right? They keep that planning going for generations to come, and they know that the decisions that they make today will affect those decisions and impact later. And so that's the thing that we got to think about as families is they're teaching us rules to stop playing so that they can keep playing. Well, it's just like with any sport. You want to get the other person out. You get the other person out of the game, that means you get to play longer. The game gets to continue on. You get to continue in the playoffs. You get to continue in the season. You get to continue to win the World Series one day. And you have all of these different aspects of, hey, how do I start thinking more along the lines of the big three rather than what they're teaching us to play by?
Well, anytime we say traditional, we're speaking to sort
Not
of
traditional, typical.
typical. We're speaking to mainstream ideas and everything like that.
Yeah,
We're definitely non-traditional in the way that we think and
non-typical.
plan, non-typical in the way we
This-
think and
So,
plan.
so let's talk about that because one of the things like oftentimes you'll hear me say typical or correct Nate, Brandon, myself about we're not saying traditional, we're trying to say typical because today typical planning is what we've been talking about. Traditional planning, believe it or not, is how people used to plan and it was a good thing. Like
Yeah.
you go back to 1942 during World War II, you would know that 50% of Americans had whole life insurance and annuities. Well, that's traditional planning. Like things worked out well. They lived long lives, they did well. And now we've got typical planning where all the statistics are terrible.
Yeah. Well, in typical planning, this idea of self-insurance has become a prevalent thought and idea. And it's centered around this idea that you buy a term, invest the difference. And eventually, when you're debt free and you've got enough assets, you won't need life insurance. But self-insurance is really a fallacy because it just means you don't have insurance. And what we were talking about earlier, if you could show up to retirement with a death benefit equal or greater than your estate, most people don't teach you how to accomplish that. We can
Yeah.
teach you how to accomplish that.
Think about it. Think about it this way, Nate. If you had $1.5 million home, right? Let's just call it a million. Make easy math. You had $1 million home and it was paid off. Would you keep your home insurance?
Would.
Okay. How much do you think a home insurance policy on $1 million home would be? Not on the coast of Florida.
Depending on the area, 2,000 to 3,000 a year.
Okay. Let's call it $3,000 a year.
All right.
Okay. $3,000 a year for home insurance on $1 million home. If you didn't have that home insurance, what would you need to do instead?
you would have to have that much money sitting in a safe place,
How much money?
enough to cover the home, $1 million,
And $1 million,
sitting in a safe
right?
place. Yeah.
Sitting in a safe place, $1 million. Because if something were to happen to that home, you would need to have the money to pay for it, right?
Yep.
So self-insurance would be keep the money in the bank in case something happens to the home, whereas buying insurance would be having home insurance, right? And that home insurance costs us $3,000 a year, right?
Yep.
Okay. Because we can't put our money at risk, we can't do anything with that money to lose the $1 million by self-insuring our home. That costs us, what do you think a good rate of return for someone would be?
A good rate of return, like
Mhm. Yeah, if they put money in them somewhere,
you know, like
market, real estate,
6%.
6%.
Yeah.
So in that conversation, by you self-insuring your home, aka not having insurance and just having the $1 million yourself there, instead of buying home insurance, it's costing you, based on a 6% rate of return, right? $57,000 a year. Well, Brock, how did you get to that? Well, because you can't do something to lose that $1 million, you can't go get the 6% because it's got to be there. It's got to stay there. Whereas if you had the home insurance for $3,000 a year, you could pay the $3,000 a year and unlock the $1 million to go invest it wherever else you wanted to. Right. So at a minimum, it's costing you $57,000 a year just by self-insuring.
Yeah. And this reality of, or the opportunity really that we have to partner with life insurance companies where we get the ability to offset our risk, and allow it to partner with an insurance company, allow them to take on risk on our behalf, is really a beautiful tool that most wealthy people understand. The middle class, oftentimes the reason why the middle class can't get ahead is because they're doing what everybody else is doing. They're not playing by the same set of rules as everybody else. Or they're playing by the same set of rules as everybody else. And people who are wealthy and have sort of broken free of that have figured out what those rules are and are operating differently.
One of my favorite stats, it's not a good stat, but one of my favorite stats to talk about, in 2024, they found that more than 90% of retirees that planned on retiring January 1st of 2024 had less than $1 million to retire on.
It's not going to last very long.
Yeah. So that is the statistic. 90% would be the majority. Why is the majority failing here? And that's what we have to change. So,
well, I just saw this clip on TikTok. This guy was talking about how he said something's messed up, and he wasn't even a finance guy. He was in the traditional workforce, maybe construction or something like that. He's like, something's messed up because we throw these retirement parties for people at my company, and then in 3 to 6 months, I see them working again. And I say, I thought you retired. Like, what are you doing? And they say, well, I still have bills to pay. He's like, that doesn't make any sense.
Yep.
And he was speaking just purely out of, from just his perspective of being a regular worker going, something's broken here.
Mm-hmm. Yeah, I'm right there with you. So I think today, I think we could wrap it up there and talking about the fact, like, you need to take a look at your life and your financial plan to understand where are the areas that I'm playing by the rules that they're teaching me to play by, and where could I break free from those and change my financial life so that I'm playing by the rules that they play by rather than the rules that they teach us to play by.
Absolutely. Hey, we hope that you got some value from this episode. Be sure to hit like, subscribe, share it with your friends, all that fun stuff. And if you'd like to have a conversation with us, just go visit cashflowlegendz.com and book a call with me. I'd be happy to visit with you and see how we can help you. You have a great day.